Hello, today I have with me Bill Ackman, one of the world's best known investors and the man behind hedge fund Pershing Square Holdings, now a FTSE 100 company. Hello, Bill, thanks for joining me.
Sure, thanks for having me.
Now, one of the big highlights of or talking points rather, of the year so far has been the GameStop event and sort of ongoing stock volatility there. Now, I mean, when that happened, what are your thoughts on retail investor activism like this?
First of all, it looks to me as a person who's used to taking an active role in companies that there's a real activist at work here. This management team has been completely transformed. There's a new major shareholder who's got a track record in, online selling and so on and so forth. It's been a meaningful investment in the company. They've taken advantage of I think they did an equity offering. I'm not following it that closely, but I think they sold some stock to raise cash. I think they're redoing some of their debt. So what's interesting is the higher stock price actually itself creates value. You got a new management team. CEO, the old CEO is gone. They replaced a whole bunch of people with people from Amazon and other places. They've got GameStop has an existing customer base of significant scale. So in all of the GameStop stories, it's always about how retail's paying a stupid price for the company. Now, again, all of this being said, I've not done the work, but it looks to me like a lot of interesting things are happening at GameStop. All of that being said, they've got a legacy in terms of a large number, got a footprint of stores around the country that they're going to have to either repurpose or get rid of. But you can envision, people going into GameStop stores and, for competitive gaming events, for the socialization of it. So I have no idea, but I think it does show you the power of retail to move stock prices. The biggest investor in the world is retail. It's not the institutions, and they are the marginal buyers and sellers, or they can be. I do think I've yet to read someone actually do the analysis, a story about, a deep dive on why GameStop might actually be worth, whatever it's trading at. I have no idea, but it could be. It's possible.
But I mean, it's happened once, it can happen again, I guess.
Yeah. So what I would say is the most significant thing is, Pershing is not a short selling firm. We've shorted a couple of stocks in our history, and the last one we did, I forswore short selling thereafter. And just being in a position where you're short a security that could go to any price, and as we know, stocks can trade at any price in the short term, is a risky proposition. It's not for the faint of heart. Not that I'm faint of heart, but I'm faint of heart with respect to short selling.
Yeah.
So that's become a very risky business. And I noticed in the opening, you call Pershing Square Holdings a hedge fund. We don't look like any other hedge fund, right? We don't have a big short book. We operate with no margin leverage. We own only 10 securities. We don't trade a lot. Our 13F doesn't change much. We have some positions we've held for 13 years, others a decade. And so I describe us as an investment holding company, but without, I compared us to the traditional conglomerate. Buffett did a comparison in his letter, Berkshire Hathaway versus a typical conglomerate. We have some very interesting attributes. If you think about us as a conglomerate, we don't have the problem of entity level taxation because we're a Guernsey company. So we can buy and sell holdings. We sold Starbucks. We're not paying any tax on that sale. We can redeploy all of those proceeds into our next investment. And we don't have a requirement to buy control, which at least in the US or in many jurisdictions, you have to have control of your underlying entities in order to not become an investment company. So I don't think of us as a hedge fund, if you will, or certainly Pershing Square Holdings, I don't. We do hedge. So maybe we deserve the historic version of the name. It's kind of funny. Most hedge funds don't really hedge. We're an investment holding company that, periodically hedges what we think of as, black swan type risks, whether it was COVID, a little more than a year ago, or the financial crisis more than a decade ago. And today, I think the biggest risk to markets is rates move a lot more than people expect.
Now, we've talked about retail investor activism. Now, what's your approach to shareholder voting? I mean, do you think should more smaller investors get involved? Are you active in this area? And do you think you can make a real difference on how companies you invest in are run? I mean, is it a good thing, or would you just rather let companies get on with running their business?
So Enormous value can be created if you have a great business that is undermanaged and you can make changes into the way the business is managed or governed. And a great example is Chipotle. 4 or so years ago, Chipotle stock was down almost 50%. And what we did is we bought 10% of the company. We were invited by the chairman CEO to put 4 directors and the other directors to add 4 directors to the board, 2 that were affiliates of ours. One of them came from McDonald's and was actually at McDonald's when they owned Chipotle. Another, a former partner of mine who knows a lot about the restaurant space. 2 other directors that we mutually approved of. And that new board, they became 4 of 8 members of the board, ultimately elected to bring in a new CEO, recruited, I think within a year, a guy named Brian Nickel. Brian's been there, 3 years or so. And, stocks come from when he joined 265 to today, 1500. We changed 1 person and a few directors. And then Brian, of course, brought in his own team and made a series of other changes that have enabled that company to create a lot of value. So, if you're looking at the kind of businesses we like to own, other people like to own. We're not unique in wanting to own a super durable growth company that you can predict with a high degree of confidence what it's going to look like over an extended period of time. But we also want to buy it at a good price. And it's rare to buy those kinds of businesses at great prices unless they're either misunderstood or shareholders are disappointed. And so it's really the latter case where we've been able to come in. We bought Canadian Pacific in I think 2012 or so, at a time when everyone hated the company and the management, and therefore the stock was at a cheap price. We bought 12, 13% of it, and then we brought in a new leader who did an incredible job of the company. The stock's up tenfold, in the last 9 years, and it's a railroad. It's not a SaaS software company. So there's an enormous value can be created because, one, you get to buy at a discounted price when shareholders are unhappy. And if you can be an influential shareholder and help, steer the company in the right direction, you can create a lot of value. And that's, I would say, the essence of our strategy over time.
And what about ethical investing, ESG, environmental, social, and governance? Now, you've been quite vocal about this recently. Now, if you could just tell us what your thoughts are and what's the portfolio's approach to ESG investing.
Sure. So we never called it ESG years ago, but we always thought about, we made an investment in the company. The simple version of this is this company good for America or bad for America, right? Our view is if it's good for America, you want the tailwinds at your back, right? If it's a polluting company, if it's a company that's causing harm to the people consuming its products, at the end of the day, it's going to have economic wins in its face, or either regulatory wins in its face. And so, our view is that, good environmental, social governance practices produce great economic outcomes over the long term. There are certainly cases where, the incremental investments you need to make to source higher quality food for Chipotle, they affect the food costs. Food costs for Chipotle are much higher than for a typical restaurant company, but their marketing costs are much lower. Their marketing costs are much lower because it's a great brand and people understand what the brand stands for. As a result, they don't need to spend a lot of money bringing people in the door. So you can if you have the ability to take a long-term approach, you can be extremely pro what's good for the world, and the rewards are enormous. So we see a lot of alignment between, our principal mission is to create shareholder value, generate attractive returns for our investors. And we think there's very high degree of correlation between that and following, sustainable, practices. And then we're in a world in which a lot of investment capital is moving toward, I would say, pro ESG decision making, and away from companies that have poor practices. And so that's a huge tailwind in just the terms of the valuations that will be assigned to businesses. Think Philip Morris, think coal company, versus Tesla. Look at the value, assigned to Tesla, because it can be in every ESG portfolio.
So does ESG form part of your investment sort of approach? So if it will be a consideration for every company that fits in the portfolio?
Sure, absolutely. And again, everyone has different views. A lot of ESG portfolios have Coca-Cola in them. And, my view on Coca-Cola is it's probably caused more economic harm than than almost any company in the world, by exporting, sugar water and therefore, obesity and diabetes all over the world. And by the way, I think it's a great company. I think it's very well run. I just don't love the product and the health implications. But everyone's going to have their own view. We also own some fast food companies that happen to sell soda. So I think differently, if you will, about a supermarket that sells a whole bunch of stuff that, the consumer can choose what they want, or a restaurant that has a spectrum of healthier and less healthy items on the menu. But, generally don't like companies that produce products that I'm not interested in consuming because I'm concerned about the health benefits. And I think that's been a good, if people sold Exxon and bought Tesla, which would be like the ultimate ESG trade of 10 years ago, that worked out very, very well.
And you didn't do that, Bill?
And I did not do that, no. My bad.
Brilliant. Look, Bill Ackman at Pershing Square Holdings, thanks very much for joining me today.
Thank you so much. Appreciate it.